Hello, and welcome. If you are here today, it is likely because you feel a tension. You feel the tension between the complexity of the financial world, the flashing screens, the endless news cycles, the sophisticated algorithms, and the nagging suspicion that the solution to your financial freedom might actually be incredibly simple. Today, we are going to explore a book that resolved that tension for millions of people. We are analyzing The Little Book of Common Sense Investing by John C. Bogle. This is not just a book summary. This is a technical dismantling of the financial industry. Over the next hour, we are going to look at the mathematics of returns, the statistical certainty of reversion to the mean, the game theory behind market participants, and the devastating impact of friction costs. John Bogle, the founder of Vanguard, did not write this book to make friends on Wall Street. He wrote it to save Main Street. He built a philosophy on a simple premise. In investing, you get what you don't pay for. Let's begin with the fundamental model of the market. Bogle asks us to strip away the stock tickers and look at what a stock market actually is. To do this, he uses the parable of the Gotrocks. Imagine a family, the Gotrocks, who own 100% of corporate America. Every share of stock in existence. As a group, they are the ultimate passive investors. They hold every factory, every patent, every service contract. Each year, corporate America generates profits. Let's say they generate a 7% return on capital. The Gotrocks family, holding all the shares, pockets that full 7%. Their wealth grows in direct proportion to the productivity of American business. This is a positive-sum game. Everyone wins because the pie is growing. But then, the helpers arrive. These are the investment bankers, the brokers, the hedge fund managers. They approach the Gotrocks cousins and say, "I can help you beat your other cousins. I see that General Electric is going down and Google is going up. Let's trade." The cousins start swapping shares. But here is the catch. The helpers charge a fee for every transaction. Now, let's look at the math. The corporate pie still grows at 7%. But the helpers take 2% of that pie in fees, commissions, and spreads. The Gotrocks family now only captures 5%. By trying to beat each other, the family as a group has mathematically guaranteed that they will lose to the market. They have turned a positive-sum game into a zero-sum game relative to each other, and a negative-sum game relative to the market. This brings us to our first major technical concept, the net return equation. Net return equals gross market return minus intermediation costs. It seems obvious, yet billions of dollars are spent every year trying to disprove it. Bogle's data is irrefutable here. He separates the market into two groups. Passive investors, they buy the index. They pay minimal fees, let's say 0.04%. Their return is virtually identical to the gross market return. Active investors, as a group, they are the market. If you remove the passive investors, the active investors own everything else. Therefore, the average active investor must earn the market return, minus their high fees, often 1.5% to 2%. Mathematically, the average passive investor must outperform the average active investor. It is not a theory, it is arithmetic. Now, let's deepen this with the Gordon equation. Many people treat the stock market like a casino, betting on price changes. Bogle treats it like a business owner. He uses the Gordon equation to forecast what returns are reasonable. The formula is total return equals investment return plus speculative return. Let's break down the investment return. This is the hard data. It consists of two things. Dividend yield, the cash companies pay you. Historically, this averages around 4.5%, though it is lower today. Earnings growth, the rate at which companies increase their profits. Historically, this tracks GDP growth, roughly 5%. So, historically, the investment return is about 9.5%. This is the gravity of the market. It is driven by economics, innovation, and productivity. Then, there is the speculative return. This is the change in the price-to-earnings, P/E ratio. If investors feel rich and optimistic, they are willing to pay $25 for $1 of earnings. The P/E goes up, and returns are boosted. If investors are panicked, they will only pay $10 for $1 of earnings. The P/E goes down, and returns are crushed. Bogle's insight, and this is critical, is that over the long term, 25+ years, the speculative return is zero.
Why?
Because valuation multiples revert to the mean. You cannot have P/E ratios expanding forever. Eventually, reality sets in. Look at the 1980s. The decade started with low P/E ratios. As optimism grew, P/E ratios expanded. The market return was massive, over 17% a year, because you had investment return plus a huge speculative return. Now look at the 2000s. We started with the dot-com bubble. P/E ratios were sky-high, over 30. They had to come down. So even though companies grew their earnings, the stock prices stayed flat for a decade. The speculative return was negative, eating up the investment return. The lesson: ignore the speculative return. It is noise. Focus on the investment return, which you capture simply by owning the index. Now, I want to talk about the most dangerous enemy you face: the tyranny of compounding costs. We all love the magic of compound interest. Einstein reportedly called it the eighth wonder of the world. But we rarely discuss its evil twin. Let's calculate the croupier's take, the cost of the financial system. When you buy an actively managed mutual fund, you aren't just paying the expense ratio, the sticker price. You are paying T costs. Expense ratio, 1.0% for an average active fund. Transaction costs, 0.5%. These are the costs the fund incurs buying and selling stocks. They are invisible to you, deducted from the fund's assets. Cash drag, 0.5%. Active funds hold cash to handle redemptions. Cash earns less than stocks, creating a drag on performance. Taxes. If you are in a taxable account, active turnover generates capital gains taxes. This can cost you another 1% a year. So, the total cost of active management can easily reach 2.5% to 3% per year. Let's run a specific example. You invest $10,000 for 50 years. The market returns 8%. Scenario A, index fund, 0.1% cost. Your return is 7.9%. Your final balance is $447,000. Scenario B, active fund, 2.5% cost. Your return is 5.5%. Your final balance is $145,000. Think about that. The market gave you a potential $447,000. The financial industry took $300,000 of it. They took 2/3 of your wealth, while taking 0% of the risk. They get paid whether the market goes up or down. You only get paid if you take the risk. Bogle calls this a moral obscenity. But surely, some managers are worth the fees? Surely some people are smart enough to beat the market? This brings us to survivorship bias and the efficient market hypothesis. Bogle acknowledges that some managers do beat the market. Peter Lynch of the Magellan Fund did it famously in the 80s. Warren Buffett has done it. The problem is, you cannot identify them in advance. Bogle cites study after study showing that past performance has zero correlation with future performance. In fact, it's often negatively correlated. The fund that is number one this year is statistically likely to be at the bottom of the list within 3 years. This is reversion to the mean again. Success attracts money. As a fund gets bigger, it becomes harder to trade without moving the market. The alpha disappears. Furthermore, the data we see is skewed by survivorship bias. If you look at a Morningstar list of funds today, you are looking at the survivors. Imagine 100 funds start in the year 2000. By 2020, 50 of them have failed and closed down because of poor performance. Their data is erased from the current funds list. So, when a broker tells you, the average fund here returned 8%, they are lying. They are excluding the funds that died. The actual experience of the investor was much, much worse. So, what is the solution? What is the Boglehead strategy? It is surprisingly rigid, yet liberating. Step 1. Asset allocation. This is the most important decision you will make. Not which stocks to buy, but how much stock to buy. Stocks are for growth, wealth accumulation. Bonds are for safety, wealth preservation. Bogle suggests a rough rule: own your age in bonds. If you are 40 years old, 40% bonds, 60% stocks. If you are 60 years old, 60% bonds, 40% stocks. Step 2. Broad diversification. Don't buy the S&P 500 alone. Buy the total stock market. The S&P 500 covers large companies. The total market includes mid-sized and small companies, the future giants. For bonds, buy the total bond market index. This includes government treasuries, corporate bonds, and mortgage-backed securities. It is the entire universe of debt. Step 3. Rebalancing. This is the mechanical engine of buy low, sell high. Imagine you have a 50-50 portfolio. The stock market crashes 20%. Now your portfolio is 40% stocks and 60% bonds. Most people panic and sell more stocks. The Boglehead buys stocks. You sell the bonds, which held their value, and buy the cheap stocks to get back to 50-50ths. You are mathematically forcing yourself to do the profitable thing when your emotions are screaming at you to do the opposite. Now, I want to pivot to my personal critique and opinion. I have spent years studying this philosophy. While I believe it is the default setting for 99% of wealth building, we must be critical thinkers. The world of 2024 is not the world of 1975. Here are 3 critical nuances you must consider. Opinion 1. The valuation problem. Bogle assumes that over time, P/E ratios are stable. However, we are currently living in an era of historically high valuations, driven by technology and passive flows. If you buy the index today, you are buying the S&P 500 at a P/E of roughly 25 or higher. If Bogle's reversion to the mean holds true, and P/E ratios drop back to the historical average of 15 over the next decade, your returns will be significantly lower than the historical 10%. You might be looking at a lost decade of flat returns. My advice: does this mean you stop indexing? No. But you must lower your expectations. Do not plan your retirement assuming 10% returns. Plan for 4% or 5%. If you get more, great. But safety first. Opinion 2. The blind spot of international stocks. Jack Bogle was famously Americentric. He believed U.S. companies were global enough. He often advised against holding international index funds. I disagree. History shows us cycles. From 2000 to 2009, the U.S. market was dead money. It returned almost nothing. Emerging markets and international stocks boomed. If you only own the U.S., you are betting on a single country's economy. That is a concentration risk. A true global citizen portfolio should be closer to the global market cap, roughly 60% U.S. and 40% international. This smooths out the ride when the dollar is weak. Opinion 3. The psychological safety valve. Bogle demands total robotic adherence. But we are primates. We like to gamble. We like the thrill. Strict indexing can be so boring that people quit. They get fear of missing out when their friend makes 100% on a crypto coin. I advocate for the core and satellite approach. Keep 90 to 95% of your money in the boring, low-cost Boglehead index funds. Do not touch it. Take the remaining 5% and call it your funny money. Buy crypto, buy Tesla, buy art. If you lose it, it won't ruin your retirement. If you win, you get the dopamine hit. This scratching the itch prevents you from blowing up your main portfolio. Conclusion. To wrap up this technical deep dive, I want to leave you with a concept called the paradox of skill. In activities like tennis or piano, if you practice more, you get better. Skill leads to victory. In investing, the market is composed of millions of highly skilled professionals. They have priced every stock perfectly. Because the skill level is so high, luck becomes the deciding factor. And because the costs of playing are so high, the average result becomes the winning result. The Little Book of Common Sense Investing is a plea for humility. It asks you to admit that you are not smarter than the collective wisdom of the entire world economy. And in that admission of humility, you find victory. By accepting the market return, minimizing your taxes, and ruthlessly cutting costs, you will end up richer than the hedge fund managers trying to outsmart you. Don't look for the needle. Buy the haystack. And most importantly, stay the course. This has been Adam, walking you through not just the math of the market, but the psychology of your own wallet. Remember, wealth is a marathon, not a sprint. Take a deep breath. Forgive yourself for the high fees you paid yesterday or the bad trades you made in the past. That is gone. Today is day one of building your real freedom. Thank you for watching.